Hello students, welcome to the EPG Pathshala. I am Dr. Rashmi Sharma, Head of the Department OBNHR, Lal Bahadur Shastri Institute of Management, Delhi. Today we will learn module Human Resource Accounting. This module is from the paper Contemporary Issues in HRM and Future Trends. In this module, you would learn human resource accounting, critical assessment, benefits, limitations of human resource accounting, methods of human resource accounting, the relevance of HRA to effective financial reporting, evaluation of HRA practices in India. After completing this module, the students will be able to provide cost value information about acquiring, developing, allocating and maintaining human resources of the organization. This would help you to understand how to enable the management to monitor the effective utilization of human resources, assess depreciation or appreciation amongst human resources, also assist in development of effective management practices. How to increase the managerial awareness of the value of human resources is also one thing that you are going to learn, and for better decisions about people based on improved information system and assisting in effective utilization of manpower. We all know what human resource accounting is. It is a process of identifying and measuring data about human resources and communicating this information to interested parties. Human capital has become one of the most important factors to measure the success of any organization. But still, many companies do not consider them as an asset which can be shown in the balance sheet. All the companies which recognize the need to show them on the balance sheet do not have a standard procedure to measure the value that is derived from the human resources. Global scenario has witnessed a massive shift from production-based economy to service-based economy. Human capital is the factor now that outweighs other production factors like raw material and physical input. Now, this transition has brought about the need to make changes to the traditional accounting practices and make provision for accounting human capital, laying significance on knowledge, skills, abilities and growing reliance on the intellectual property. The stock of human capital of any company would create a competitive advantage owing to their own knowledge and unique talent. And supposing a company loses its workforce overnight, automatically the value of that organization is going to depreciate significantly. Despite the fact that human capital has so much of value, for years it did not feature in account statement of organizations due to difficulty in quantifying this data. This is the major challenge that is faced by researchers and good academicians to find a way to report the value that is derived from human capital in a consistent, accurate and objective manner in the balance sheet. Let's understand the human resource accounting critical assessment. Human resource accounting is a cost-benefit analysis of all the investment that is done on human resources of the organizations in terms of recruitment, selection, hiring, training and development, and also the benefits that are derived from them owing to their knowledge, skills, ability and productivity. An organization will be profitable if it derives more benefits at less expenditure. Human resource accounting has the potential to become a key driver of decision making, especially in the service-oriented industry, where human resource management is one of the main cost centers. Most prominent classes of decision makers who are likely to be affected by this financial accounting of human capital are the managers who are accountable for resource allocation and investors. Investors will particularly be interested in the current state of business and growth opportunities, whereas the managers would be interested in cost aspect associated with the human capital. But the question is whether accounting of the human capital is possible. Can human capital be treated as an asset that can be measured or quantified? If yes, then what are we actually measuring, and can we establish a standard procedure for the same that will give uniform results across businesses? Assets are required and acquired through transaction and have net future economic benefits. But as per the traditional economic analysis of wage rate determination, net economic benefit should be zero. As per the marginal productivity theory, net human resources value in equilibrium should be zero, which might not hold relevance in today's environment where positive value exists due to imperfections of firms resorting to giving non-monetary employee compensation, which leads to increased productivity at reduced cost, or highly mechanized work environment that increases the resource efficiency. It is desirable for the firms to be able to create net human resources value that are greater than the expenditure. Let's understand the benefits of human resource accounting. The system of HRA, that is human resource accounting, discloses the value of human resources, which helps in proper interpretation of the return on capital employed. Managerial decision making can be improved with the help of human resource accounting. The implementation of human resource accounting clearly identifies the human resources as valuable assets, which helps in preventing the misuse of human resources by the superiors as well as the management. It helps in effective and efficient utilization of human resources and understanding the evil effects of labor unrest on the quality of human resources. The system can increase productivity because the human talent, devotion and skills are considered as valuable assets, which can boost the morale of the employees. It can assist the management for implementing the best methods of wages and salary administration. Let's first now understand what are the limitations of human resource accounting. The valuation methods have certain disadvantages as well as advantages. Therefore, there is always a bone of contention among the firms as to which method is to be treated as an ideal one. There are no standardized procedures that have been developed so far. Therefore, organizations are providing only an additional information. Under the conventional accounting, certain standards are accepted commonly, which is not possible under this method. All the methods of accounting for human assets are based on certain assumptions which can go wrong at any point of time. For example, it is assumed that all workers would continue to work in the same organization till retirement, which is very difficult to imagine in the current scenario. It is believed that human resources do not suffer depreciation, and in fact they always appreciate. This can also prove otherwise in certain organizations. The lifespan of human resources cannot be estimated, so we can say that the valuation seems to be unrealistic. There are several methods of human resource accounting. Many research papers have suggested the methods of human accounting by evaluating individual contributions and assigning values to them. Though it is difficult to isolate an individual contribution from team or group effort, but these have much more potential to aid in the decision making. Let's understand this historical cost method. The first attempt towards measuring the human resource was made by a footwear manufacturing company, that is R.G. Berry Corporation of Columbus, Ohio, with the help of Michigan University in 1967. R.G. Berry Corporation was the first organization to use this method for human resource accounting. This method uses historical data, that is cost associated with recruiting and training resources. This method poses several constraints, which include: people are efficient enough to acquire skills to enhance their productivity even without organizations conducting specialized training for the same. For example, a software professional who gains proficiency in MS Excel software can leverage this from team management and data analysis without being given any formal training by the organization. Different individuals respond to trainings differently and they might produce the same results. Individuals are capable of developing processes that have far-fetching impact that no amount of training can bring. Training does not always produce the desired effect. Sometimes they have a negative effect in situations where the resources are forced to attend certain behavioral trainings. The rate at which individuals grow and deteriorate is different, so there is a need in the organization to assess it. Also, the changes are difficult to predict and they pose the biggest challenge in terms of estimation of value derived from human capital. Replacement cost method. This model was proposed by Flamholz and uses cost incurred for hiring people for existing positions, movement within and outside the organization, and learning and development cost. There are limitations to this approach as well, which are as follows. This approach considers salary data and doesn't take into account some employees are underpaid while others are overpaid, and salary cannot be the only measure to gauge employee value. Secondly, Flamholz considers the individual values and doesn't take into account benefits derived out of team efforts and goals. Let's understand now what is the future scope of human resource accounting. To be able to leverage human resource accounting for decision making, the following should be ensured: the standardized form to represent human resource information, proper approach to measure and establish human resource value to be developed, research to establish the impact of human resource accounting in enhancing the organizational effectiveness and decision making. Most importantly, managers must be equipped to be able to think and apply information obtained from human resource accounting in practical application and scenarios. In this illustration, we can see what are the benefits of a human resource accounting. It calls for proper investment, planning and executing the personnel policies, improving employee efficiency, helps in calculating the ROI, that is return on investment, and also the cost of developing the human resources. Let's now understand the relevance of human resource accounting to effective financial reporting. A researcher, Stephen Knopf, in 1983 defined human resource accounting as the measurement and quantification of human organizational inputs such as recruiting, training, experience and commitment. Primarily, there are two reasons that are taken into account while treating the human resources as assets. They are: investors will use this information for business valuation. Massive investment in building the human capital of an organization justifies their being treated as assets. The gap in this accounting research arises due to the confusion about where exactly to place the human assets in the balance sheet and the implication of recruitment policies on such assets. There are certain theoretical framework that we must discuss in this module. The learning curve theory. This theory states that when a new job begins, the workforce does not reach the maximum efficiency or productivity. As these people master the techniques, productivity increases and it achieves the stability which takes some time to finish the job, but eventually it declines until it reaches a stability. Every time the output doubles, cumulative average time per decrease by a constant percentage called the learning percentage in this formula is denoted by P. The formula for calculating the human resource accounting is where K is the direct labor hours to produce the first unit, Yx is the direct labor hours to produce the xth unit, and X is the unit number. Now let's understand the Lev and the Schwartz model. As per this model, we calculate the future earnings of an employee during the remaining service period and then calculating the present value by discounting it at the cost of capital. This method finds its application when relevant data that can be quantified and analyzed is available. As you can see on the screen, the formula can be written as here EVY is the expected value of Y year, that is the old person's human capital. T is the person's retirement age. PYT is the probability of the person leaving the organization, and 1T is equal to the expected earnings of that person in the period I, and R is the discount rate. Now let us understand the next model, that's the Morse model. According to this model, value of human resources is equal to the present value of the net benefits that are derived from employees by the organization. The steps involved in this model are individuals as well as collective gross value of services are to be rendered by employees in future is to be determined. Both direct and indirect form of payment that is to be made to the employees are to be determined. Net benefits owing to the excess of value derived over payments are to be ascertained. The present value of net benefits are determined by discounting at a predetermined rate. The next model that we are going to talk about is Likert and Bowers model. Researchers Likert and Bowers have proposed three variables, namely causal, intervening and end result variables, to determine the value that is added by the group as their contribution to the organization. These variables include managerial behavior, capabilities, group processes, climate and the subordinate satisfaction. Both the causal and the intervening variables determine the end result variables that reflect achievements of the organization in terms of sales, cost, market earning, etc. Let's refer to a particular case study that was done on Oceanic Bank. Annual reports for 5 years starting from 2002 were examined. The Lev and Schwartz model was used to analyze the value of human resources. The assumptions that were taken were that employees remain for a minimum of 5 years in the organization and the cost of capital is just 10%. Analytical technique was further employed to test the impact of human resource accounting using simple linear regression equation. The data was analyzed and represented as the slide given here. The value of R came out to be 0.968 and the DF as 4. high coefficient of correlation exists between the total assets and PAT, which includes that the variables are useful in explaining the impact of assets, including the human capital on profit. The Durbin-Watson statistic indicates that there is no problem of serial correlation in the regression model that was shown in the previous slide. In this slide, we can see how return on assets have been calculated. The data that has been taken from the year 2002 till 2006 has been analyzed, and we can see what are the return on assets with HRA, that is human resource accounting, and without human resource accounting. The figures show a significant change. Rate of return was determined to measure the differences of return on assets with and without human accounting capital. From the data that was presented in the previous slide, it is evident that inclusion of human resource accounted increases the value of return on assets. From the study carried out, it is evident that human assets affect profit and capital employed. The human asset value increases the investment in the organization as investors have the assurance that their resources will be effectively and efficiently managed to create wealth. From the study carried out, it is evident that human assets affect the profit and capital employed. The human asset value creation increases the investment in the organization as investors have the assurance that their resources will be effectively and efficiently managed to create wealth. Let's take up some examples of how evaluation of human resource accounting have been done in select few companies in India. In India, human resource accounting as a concept was introduced in the annual reports for the first time by Bharat Heavy Electricals Limited, post which several other companies including GAIL, ONGC, NTPC, MMTC, SAIL, EIL, PEC, HSL, Mecon, etc. followed the trend. Most of the organizations follow the Lev and Schwartz model, which is the present value of future earning model. The same model was also followed by the famous IT company Infosys for accounting purposes. The formula suggested by Lev and Schwartz is as given on the screen. EVT is the expected value of the human capital. PT bracket T is the probability of a person's dying at age T. II is equal to the value of a person's each possible service, state or future annual earnings. For application of this formula, firstly, the employees are divided according to their age into homogeneous groups, that is skilled, semi-skilled or unskilled. The present value of an average earning for each group is calculated. It is assumed that employees will not change their role during the service period in the organization. The best aspect about this model is that lies in its objectivity in valuing the human resources and the limitation of the assumption of resources not changing their roles during their service tenure. In fact, major learning in any organization occurs due to the change of roles. Also, it doesn't take into account the value of an employee is not solely due to skills but also the kind of roles he takes up. Other limitation is that it does not take into account the employee turnover. Let's see how human resource accounting was done at Infosys. Infosys has been disclosing valuation of HR in its annual report in supplementary statement, also as a part of the balance sheet that includes intangible assets. ITL has shown category-wise value of its resources, also some critical HR ratios, but does not mention appreciation or depreciation in value. The HRA has provided them with critical information regarding the number of employees, cost and value of its resources. Percentage increase in the number of resources between 2002 to 2003 and 2007 to 2008 was 493.82. The total employee cost has been an increasing from rupees 1677 crore in 2002 to 2003 to rupees 8878 crores in 2007 and 2008. Although the total employee cost was increased by 429.39%, cost per employee decreased by 11%. The increase in valuation of HR is largely due to decreased discounting rate. Positive high correlation of 0.999 between total income and total employee cost indicates that the employee performance at Infosys is efficient. The findings and recommendations from what we have observed as an HRA practice in Infosys reveals the following. Infosys hasn't disclosed training and development cost, induction cost, etc. It should make a separate entry for these. Infosys must also account amortization of resources, lockouts, etc. Keeping a constant rate of discounting will eliminate incompatibility issues in HR ratios and also help in better decisions owing to standard results. Frequent HR audits will help to enhance the credibility of data. As a conclusion, it can be said that human resource accounting practices at Infosys are good and can be further improved if sufficient measures and practices are put into place. Thus, we may say that human resource accounting is basically a cost-benefit analysis of all the investment done on human resources of the organization in terms of recruitment, selection, training, hiring and development, and also the benefits derived from them owing to their knowledge, skills, ability and productivity. An organization will only be profitable if it derives more benefit at less expenditure. The HRA has potential to become a key driver of decision making, especially in the service-oriented industry where human resource management is one of the most primary cost centers. Most prominent classes of decision makers who are likely to be affected by this financial accounting of human capital are managers who are accountable for resource allocation and the investors. Investors will particularly be interested in the current state of business and growth opportunities, whereas managers would be interested in the cost aspect associated with the human capital. In this module, we have understood the definition of human resource accounting and gained a deeper insight into its working as a system for monetizing, recording and accounting for the human capital of an organization. We have also identified the relevance of developing a system of accounting its human capital in today's ever-changing HR dynamics and the value that it creates for the organization in terms of increased accountability. There are two reasons that are taken into account while treating the human resources as assets. They are: investors will use this information for business valuation, and massive investment in building human capital of an organization justifies their being treated as assets. Different methods and models of human resource accounting were discussed, along with examples from the Indian scenario of the companies that have successfully used this technique to leverage decision making. The Lev and Schwartz model helped us to calculate the future earnings of an employee during the remaining service period and then calculating the present value by discounting its cost of capital. As per the Morse model, the value of human resources was equal to the present value of net benefits derived from employees by the organization. The Likert and Bowers model has variables, namely causal, intervening and end result variables, to determine the value added by the group as their contribution to the organization. From the research papers that were included in the module, we could understand that the majority of companies use Lev and Schwartz model for inclusion of human resources in the balance sheet. But the bigger challenge is educating managers and investors to decipher the information and use it wisely for decision making. Companies have begun to realize the importance of human resource accounting owing to rapid advancement from production-based to service-based economy. Though they face a lot of difficulty in devising a process that can consistently and efficiently measure the value and contribution that is derived from human resources. HRA is yet to gain momentum in India, and there are several limitations that include the valuation methods have advantages and disadvantages, thus it is difficult to identify the suitable one. There are no standardized procedures developed so far. Under conventional accounting, certain standards are accepted commonly, which is not possible under this method. All the methods of accounting for human assets are based on certain assumptions, which can go wrong at many times. It is believed that human resources do not suffer depreciation, and in fact they always appreciate, which can also prove otherwise in certain organizations. And finally, the lifespan of human resources cannot be estimated. In India, HRA was introduced in annual reports for the first time by BHEL, that is Bharat Heavy Electricals Limited, post which several other companies including GAIL, that is GAIL, ONGC, NTPC, MMTC, SAIL, SAIL, that is EIL, PEC, HCL, MECON, etc. followed the trend. Most of the organizations in India follow Lev and Schwartz model, which is the present value of future earning model. The example of Infosys was elaborated in this module, and it was found that Infosys has very good human resource accounting processes. Thank you.